get underway if we can. Thank you to all of you that have joined again. My name's Richard Basil-Jones. I'm the CEO for the Australia-UK Chamber of Commerce, and we're about to climb into setting up in the UK Part 2 webinar. Just to give you a quick overview, two-part series. Certainly it's not meant to get into the weeds in the detail, but certainly to give you at least a broad brush look and information on key areas about those companies and individuals thinking or considering setting up in the United Kingdom. We had a very successful Part 1 webinar where we had close to around 90 people that sort of climbed in live. And what we did see is a lot of people watch this video and recording at a later time. So just to repeat that, this video and webinar will be recorded and it will be hosted on our website. Just very briefly, Australia-UK Chamber of Commerce, who we are, we're a member organisation, independent and not-for-profit. We operate here out of Australia House in London. We have around 160 member companies. And our role is to support companies that have interests in both Australia and the UK. Now, typically, those companies are Australian companies, but not all of them. For example, we have Chelsea Football Club and Tottenham Football Club as members, certainly not Australian companies. But we have various companies at various sizes, including startups, individuals, small, medium enterprises, and the big chartered. And our role is to try and facilitate information sharing, connections, collaborations, and creating a business community. And we do that typically through events. So that's the role we play. This setting up in the UK webinar is, if you like, a good example where we bring our member companies with their specialist knowledge onto or into the event to help inform those that have an interest in that particular topic. So that's what it is. We've got about an hour and a half this morning or this evening if you're in Australia. So we're going to get cracking with this particular webinar. My first introduction will be to David Camerlengo. And David is our Senior Commissioner, Trade Investment Commissioner here based in London in Australia House. But he's probably the easiest way to describe him. He heads up Austrade in the UK. That's possibly the easiest way to describe David. So David's going to provide a brief outline of the Aus-UK Free Trade Agreement to give you a sense of that framework and why that trade agreement that came into place in May 2023 is so important for those people on this webinar. So David, over to you, and I'll ask the other speakers that we have here on feature to turn off their cameras and mics. Thank you.
Amazing. Lovely, Richard. Thank you so much. Hello, everybody. Lovely to see you all virtually online. Welcome from the Australian High Commission here in London. Firstly, I just want to say a huge thanks to Richard, Nicole, Vera, and the Chamber for putting on this series of webinars. This is the second part of it. It's some incredibly useful content, I think, for Australian businesses. A little bit of background. So Austrade, we're the Australian government's, for those that aren't aware, Australian government's trade and investment agency. We basically deliver quality services for trade and investment services for Australian businesses to help them with their international agenda, and also services for foreign direct investors bringing FDI into Australia as well. I spoke a little bit last week about the opportunities in the UK on the first part of this webinar, so I'm not going to repeat that too much, but if you're interested, I gave a few highlights around the UK's ambitious growth agenda with the Labor government. Also gave a bit of a highlight around the UK is not just London. It's much broader than that in terms of the economic opportunities, and it's great to see today that we've got Department for Business and Trade and the West Midlands Growth Company representatives here talking about, I think, broader opportunities also. So I'm just what I will just highlight is, because I think it is important perhaps to repeat, is the Australia-UK Free Trade Agreement that, as Richard mentioned, went into force in May of 2023. So we're rapidly arriving to our 2-year anniversary of that FTA being in force. It is, one of the most comprehensive, innovative, and ambitious free trade agreements that Australia has concluded to date. It really already strengthens what is already quite a strong trade and investment relationship between the UK, but it's got some unique benefits, and it's not just all about, you know, goods and the elimination of tariffs on goods. It's actually much broader than that. So I'll just go through a few highlights that I think might be relevant to your businesses as you're embarking on your journey in the UK. So on the good side, it is still very important to mention. So tariffs have been eliminated on over 99% of Australian goods within 5 years. There are transitional quotas for certain products such as beef, sheep meat, sugar, and dairy products. But a big part of our trading relationship with the UK is services. Over 50% of our trade is actually services with the UK, which is quite significant compared to other markets. And the FTA includes some substantial access for services companies, including a chapter dedicated to mutual recognition of professional qualifications to help make it easier for those that are coming into the UK and vice versa to be able to practice in each other's jurisdictions. The other area that is quite significant in this free trade agreement is the mobility provisions between both jurisdictions, quite reciprocal as well. So there are enhanced opportunities for people to live and work temporarily in each other countries. That ranges from youth mobility visas, working holiday visas, where the visa duration has been extended to 3 years, and the age limit has been extended or increased up to from 30 up to the age of 35, which is quite beneficial. But there's other benefits, there's other unique mobility provisions for intra-corporate transferees, for people that are coming in on a contract as a service supplier, and for independent professionals to come in as well. So happy to provide details, as I'm sure some of the chamber members that specialise in immigration can provide. There's also some provisions around digital, so rules on data flows to encourage more streamlined flow of data, including limiting localization requirements for data, and also support of electronic contracts between both countries. There's provisions around access to government procurement. So that is essentially on providing businesses on both sides the ability to bid on government procurement contracts on an equal footing with domestic firms. There's the first ever chapter on innovation in one of our free trade agreements, and that includes a dedicated strategic innovation dialogue. There's an entire chapter on financial services, and there are provisions around investment flows between Australia and the UK, where the screening thresholds have in fact been raised to allow the greater flow of investment flows between Australia and the UK. And as probably some of you will be aware, we have already a very strong investment relationship with the UK, where the UK is our second largest source country of foreign direct investment into Australia. But similarly, the UK is the second largest destination for Australian FDI outbound. So look, this free trade agreement, we encourage you to understand it, to think about it, to try to utilize it, to ask questions if you will. It's there to support your businesses. You know, we use the analogy of it's the train tracks, and your businesses and firms are the railway cars, and the passengers that need to make use of those railway tracks. So please make use of them. And just a quick mention in terms of Austrade, and we work very closely with the state and territory governments. We've got 5 mainland Australian state governments that are represented here in London. We work with them quite closely on a number of initiatives. So please, if you're interested in learning more about how we can support you, please reach out to our team here at Austrade, or any of the state government representatives that are here as well. But with that, I'll hand back to Richard and wish you well on your journey. Thanks, Richard.
Thanks, David. And look, if I could just reinforce David's comments about reaching out to not only Austrade, but potentially your respective state trade investment or territory investment organisations. We witness it here in the United Kingdom, how helpful they are in supporting and informing and advising companies that are coming in to set up in the UK, and vice versa. But we see primarily companies coming into the UK. So we're fantastic supporters. So in that same breath, what is wonderful in this Oz-UK Free Trade Agreement is that I can tell you there is a genuine commitment from both sides to make this work. And the UK government has really, and I mean this because, again, we've seen it firsthand, has been incredibly positive, incredibly active around this free trade agreement to make it work and bring it to life. And on that basis, we wanted to bring someone from the Department for Business and Trade into this webinar to really give you a sense of the resources and support that they can provide here in the UK, but also they do have offices in Australia. So on that note, I'm going to introduce you to Stephen Metti, who's Head of Asia, FDI Markets and Partnerships for the Department for Business and Trade. So Stephen, over to you.
Thank you very much. Just setting up my slide presentation. So hopefully you'll see that. So thank you very much for inviting me to speak today. It's a pleasure to speak to you all. So I'm Steve Metti. I'm the Head of Foreign Direct Investment from Asia Pacific in the Department for Business and Trade. I'm here to talk to you today about DBT. Why you should consider investing, expanding your business in the UK, and support for investors. So what is the Department for Business and Trade? Well, DBT is the Department for Economic Growth in the UK. We support both overseas companies investing in the UK, whether it's with setting up new operations or with expansions and relocation within the UK. DBT also supports British companies to export and invest overseas, which is also accessible to you, companies such as yours, once you have set up here. Our HQ is located in Whitehall in London, but we do have offices throughout the UK. And we work very closely with regional and local partners, including the West Midlands Growth Company in England, who you'll hear from today, plus the nations in Wales, Scotland, and Northern Ireland. We also have representation overseas. In Australia, we have offices in Sydney, Melbourne, Brisbane, and Perth. We have a range of services to help you set up and expand your business in the UK, which I'll speak more about later. So why consider setting up in the UK? Well, the UK has a strong track record of welcoming foreign direct investment. DBT supports over 1,000 international investment projects coming into the UK each year. The UK has attracted a greater stock of FDI than Germany and France combined in recent years. We lead Europe on FDI, on project value, jobs and capital expenditure, which reflects on the government's strategic efforts to double down its commitment on to supporting higher value investors into the UK. I'm pleased to say last year, 47 Australian companies set up in the UK that we know of, created over 1,100 jobs in sectors including automotive, foreign and professional services, tech, creative, healthcare, energy, and so on. So a wide range of sectors Australian companies are investing in the UK. So why do companies invest in the UK? I won't go through everything on this slide, but really just to emphasize how attractive the UK is for investors. We are the 6th largest economy in the world, home to 68.2 million people. So the UK offers investors not only a significant market, but one of the simplest countries in the world in which to set up business. It's very easy to set up a company. It costs about £50, and you can do this within 24 hours. UK is continually expanding its investor base. Executives recognize and values the attractiveness of the UK offering for their business and expansions. The UK retained its position as #1 recipient of new projects across Europe, according to the EY Attractiveness Survey last year. And the sentiment towards the UK is increasingly positive, with 69% of investors surveyed planning to invest in the UK in 2024 and 2025. I'll also touch very briefly on the competitive business environment. The skills, there's a highly skilled, diverse workforce, very important for investors looking to grow their business in the UK. The UK holds a globally recognised higher educational system, allowing business to have access to the sorts of transferable critical thinking skills that drive innovation and business growth. The UK's flexible labour law liberal labour laws set the right environment for visitors to make the most of the UK's rich talent available, whilst accommodating immigration rules to attract the best talent from around the world. So there's a lot about the business environment that's very attractive. I can also say we're globally competitive, we have well-established financial systems, and also the lowest corporation tax within the G7. So talking a little bit about the future, David mentioned the FTA, mentioned the government's growth agenda. So companies doing business in the UK, setting up in the UK, will benefit from the soon-to-be-released Modern Industrial Strategy Invest 2035. This is the UK government's 10-year plan to deliver certainty and stability businesses need to invest in the high-growth sectors that would drive our growth mission. The strategy will focus on tackling business barriers to growth in UK's highest potential growth driving sectors and places. This will create the right conditions for increased investment, high quality jobs, ensuring tangible impact in communities right across the UK. So again, what David was saying about the focus not just being in London, but outside of London to drive growth for the country. As you can see on the screen, there are 8 growth driving sectors with high potential for economic expansion. These being advanced manufacturing, clean energy industries, creative industries, defence, digital and technologies, financial services, life sciences and professional business services. The government will produce plans for each sector as part of its commitment to help them drive through its ambition. So funding through funding and tax relief to create certainty and drive growth, and funding for vital R&D, building talent and resilience. The government will also extend the Made Smarter innovation programme to support more small manufacturing business to adopt advanced digital technologies and enable the programme to be expanded to all English regions. So again, this is making sure that we have more of a balanced approach to growing the economy outside of London and the South East. So I'd like just to quickly go through our services. So DBT welcomes high growth, ambitious Australian companies to invest in the UK. DBT services are aimed at supporting investors that can meet strategic priorities, such as contributing towards regional growth, for example, creating jobs, deferring capital outside of London and the South East. Also to growing our UK scientific base and contributing towards the clean energy agenda. We're very keen to support companies that contribute towards sectoral priorities, and the industrial strategy has outlined these and will help to define these further. Also companies contributing towards economic impact. So again, this is really about the nuts and bolts of what we do and why we do FDI, which is to help create jobs and to help companies grow their business in the UK, spending money on the economy and in their businesses. Those meeting the criteria will be provided support from a virtual team led by a DBT project manager or a local partner in England, one based in one of the nations in Wales, Scotland and Northern Ireland. So our services are quite wide, really. It really depends on what you need, but essentially we can provide links to centres of excellence such as universities and trade associations, and provide information on sectors and place-based propositions. Our business environment team support investors with complex issues and advocate the needs of investors in government policy making, and including finance, planning, skills and migration. So there's a wealth of specialist support there to help you in those particular areas. We provide help with site and property search. We can help with comprehensive regional and location analysis, so comparing regions and also comparing the UK with other competitor markets. So if you're thinking about setting up in Germany and France, we can set up benchmarking to show you how your cost and needs would be compared to those markets. So you'll find that UK has a very compelling proposition, but if you're unsure, we can help with that benchmarking. When you visit the UK, your project manager, local partners can help with your visit. So if you're looking to look at sites, understand more about the UK proposition and so on, we can help you meet the right people to enable you to do so. Again, I'll just mention our offices in Brisbane, Melbourne, Perth and Sydney that can help you access these services, and also to attend local events and connections that they have within Australia that will help you understand the UK better. So finally, just wanted to highlight our Expand Your Business service. So this is our digital offer. So you can obtain information quickly by registering for the Expand Your Business digital service. There's a QR code at the bottom right there. So feel free to scan that and register for the support that you can get through the digital service. As you can see, you can receive information on core business issues such as registration, visas, bank accounts, tax, and so on. But also, I think what will be of interest to many of you, and I understand there's a diverse range of sectors on this call dialing in. So there's pretty much something for everybody. There's a lot of information there, so please do go in, find out what is good for you, and use that information then to inform your decisions about setting up in the UK. There's also information on venture capital, raising capital, regional content, trade associations, and tools to help you find out further information. So please register. It's a very quick service. It's free. It's primarily aimed at our more nimble investors, so those that want information quickly. Please use it. But if your investment is deemed to be a high value, high strategic investment, then that will get filtered through and receive a project manager to help you with setting up in the UK. So that's my, if you like, whistle-stop tour through UK services and who we are. So thank you very much. Hope you found this presentation useful. You can use the link there to look at the broader services that DBT offers investors, but also on that page you can find services for trade as well. So if you're already set up in the UK, you can access those services as a UK company looking to export overseas. So thank you very much. I'll hand over to Richard.
Thanks, Stephen. Here's the quick summary already to all those people on the call. There's a lot of resources out there to support you in this journey. We had a case study last week of a company just talked about their journey to the UK. It was one of those, I wish I knew then what I know now. And that's reaching out into not only the Austrades and the state trade investments, but also the DBT. And the next part, which is the one I'm about to introduce, is into the companies that we're connected with that are specialists, to have the specialist knowledge on setting up businesses in the UK. It makes the process a heck of a lot easier, I can assure you. Just very briefly before I introduce the next speaking slot, just to remind everyone, there's a Q&A button at the very top of your screen. We will have a Q&A at the end of this webinar, so please submit your questions and we'll do our best to answer them either on the webinar or following the webinar itself. If I may now introduce you to one of our great member companies, H.W. Fisher. H.W. Fisher are expert in accountancy, audit, tax, corporate and financial advisory services. We work with them closely. They have expertise in all sorts of areas, helping companies and individuals looking to set up in the UK. We have three of their specialist speakers today. We have got Toby Ryland, we have Bonell and Gerry Myton, who will speak to you across a few different areas about the corporate structuring, global mobility, and also VAT and duty, and also R&D credits and the like. So covering a fair bit of content here, but you'll see there's a lot to be considered, and this will give you a great introduction to some of those important topics. So on that particular note, I will hand over to Toby.
Thank you very much, Richard, and nice to meet everybody virtually. So, as Richard very kindly introduced us, we are a firm of chartered accountants and tax advisors based in central London. We have a lot of experience dealing with inward investors into the UK from all around the world. But obviously we have quite a focus on Australia and helping Australian businesses set up in the UK and prosper here. So what we will be doing is running you through corporate structuring and corporate tax issues at a fairly high level. Then we'll be running through global mobility, which is largely moving employees cross-border. And then I'll be passing over to Gerry Myton, who will run through VAT, our equivalent of GST, and customs duties. So let's kick off with corporate structuring, inward investment into the UK. I think as Stephen quite comprehensively outlined, the UK is a very business-friendly jurisdiction. The government is saying that growth and economic growth is their absolute key priority for the course of the next Parliament. And the UK has historically had a very keen focus on attracting inward investment into the UK. So this is a continuation of a long-standing policy. I should also make the point that the UK is not just London. There are many opportunities throughout the UK. There are lots of regional incentives available to attract businesses to different parts of the UK. So whilst London is often seen as the key focus, there are opportunities throughout the country. The sort of financial incentives available range from things such as reduced business rates, reduced stamp duty, increased tax depreciation allowances, through to the simplification of planning permission if you need to build premises, factories, industrial buildings and similar. And there are also various grants available to businesses investing in the UK. So there's definitely something worth looking at, not just focusing on London, but looking at the UK as a whole. The other big benefit of the UK is that we've got a very stable tax and legal system. It's straightforward to open here, it's straightforward to do business here, and the whole system is designed to make it as business friendly as possible. On top of this, we also have a very wide tax treaty network, probably the widest of all countries globally. So it's generally easy to operate from the UK and work with different territories, whether that's just in terms of repatriating profits, financing businesses either into the UK or from the UK and more widely. We've got a very, very good tax-friendly treaty network. And as Stephen referred to a few minutes ago, we've got a good competitive low corporation tax rate compared to most of our EU competitors and more widely. So moving on now to how do you actually set up in the UK? There are broadly two main options. So either having a branch, which is just an extension of your Australian existing company, so you would just start to operate here, but it would be the Australian company actually operating in the UK, or you would set up a UK limited liability company as a subsidiary of your Australian parent. The tax difference between a branch and a subsidiary is fairly immaterial. They're both broadly taxed in the same way, but there are some quite stark differences in terms of how they have to report and also how they're perceived. So a branch is very straightforward. There is no separate entity. It's just simply a business registration here. So it's quite simple, but there are disclosure requirements. So if you had a branch of an Australian company, then the Australian company would have to register that branch and be visible on our company's house here. And it would also be required to file the Australian company's financial statements at company's house here in the UK, which are open to public inspection. And so details of ownership and things like that will become publicly available here. Now, in terms of Australia, that may not be too much of a concern due to your disclosure requirements in Australia, but for a lot of other territories, this is quite a significant drawback. The other point is that a branch is not a separate entity from a legal perspective. So if the branch is subject to litigation, it's actually not the branch itself, but it's the Australian company that would be at risk. So that's why a lot of businesses prefer to have a UK subsidiary, a separate limited company. If you do that and you set up a UK limited company as a subsidiary, the subsidiary prepares financial statements and publishes them, but there's no reference to the parent company. And also, if there's any legal risk, it would be the subsidiary company itself which is at risk and not the Australian parent. So for those reasons, we usually find that the preference is to incorporate a UK limited liability company to operate in the UK. And then beyond that, there is perception. Rightly or wrongly, it's seen that a branch has less substance and can be closed down and disappear much more easily than a limited liability UK company. So just from dealing with the public, dealing with other businesses, there's often a feeling that a subsidiary is a better option than a branch. So then moving on to what are the tax rates? The UK, as we say, is quite competitive. The main tax rate is 25%, which is lower than the other G7 nations. And it's a fairly static rate. There is a small lower rate for very, very small companies, but you can broadly plan that you will be paying 25% corporation tax on profits realised here in the UK. The other main cost to businesses operating here is our social security, known as national insurance contributions. This is currently 13.8%, but is increasing to 15% in April. The government will hopefully not be doing anything beyond that increase. And that's paid, it's the employer's contribution paid on the wages that are paid to employees here in the UK. Our corporation tax is payable typically on a quarterly basis. So you pay 25% of your liability each quarter, totaling 100% over the course of a 12-month period. This does apply for large companies where profits are over £1.5 million sterling, but those limits are reduced by the number of companies worldwide. So if you had an Australian parent with a UK subsidiary, the limit drops to 750,000. So a lot of companies will be paying in instalments. For those companies that drop below those limits, they would pay their tax 9 months after their year end. So it's relatively straightforward in terms of tax payment dates, and it's just a matter of monitoring them. The big advantages of the UK and the tax system, which Stephen referred to these very briefly, is we have no withholding tax on dividends. So if you have a UK subsidiary wants to repatriate its profits and pay a dividend to its Australian parent company, there's zero withholding tax on those dividends. We do have some withholding taxes on interest and royalties, but under the double tax treaty with Australia, these are reduced to 10% and 5% respectively. And then we do have some nice tax reliefs. So we've got R&D tax relief. There's now one main scheme. It's been simplified quite significantly with an enhanced R&D scheme for new startups which are loss-making. But very broadly, what this does is give up to 27% of your R&D expenditure back to the company. So effectively, the UK funds over a quarter of your R&D spend. There is quite a lot of focus in the UK now by the tax authorities to make sure that the scheme is being operated and owned correctly, and that only genuine R&D is able to obtain the relief, but it's something that's very beneficial, and we can help you through that process. Compliance obligations are fairly straightforward. You file financial statements once a year. You file a corporation tax return once a year. Payroll is operated usually on a monthly basis. If you offer share incentives like share options or other sort of equity incentives to any employees, there is an annual return just reporting that to the tax authorities. There will be VAT returns to file, usually on a quarterly basis, can be more regular in certain circumstances, and there will be a company's house annual return to file. Excuse me, but so these are fairly straightforward, probably not dissimilar to what you're used to in Australia. And the key thing is just to plan for these, which we can help with, keeping a record of when your accounts, when your tax returns, when your other filings are due, to make sure that no penalties for late filing are incurred. But we can help with that process and make sure that everything runs as smoothly as possible and take some of the stress away from opening a business in a foreign current country. So it's a very brief overview. There's obviously a lot more detail, but hopefully it gives you a feel for what it's like on the corporate side to operate and trade in the UK. And so now I will pass over to my colleague Adam Bonell, who will talk through the global mobility and employment tax considerations.
Okay, thank you, Toby. Good evening, good afternoon, good morning. So my name's Adam Bonell. No connection to Australia's biggest family, but I am a tax partner here at HW Fisher, and I work with Toby and Gerry to essentially bring businesses into the UK. And my particular focus is looking after the employees and their families and looking at the employment taxes and the income taxes that arise out of this. So on that note, I just wanted to talk about some employee issues today. So the key employees, I've broken them down into 4 categories here, you can see on the screen. And I just wanted to run through each of these in turn and just highlight some of the issues that we typically see during different stages of the business transitioning to the UK. So if I could have the first slide, please, Toby. So short-term business visitors, and this is essentially, I suppose, quite often what you see, you've got an Australian business, they may send employees to the UK from the Australian entity just to sort of test the water, see what markets are available. And technically, if you have an individual who works in the UK for a single day, their earnings in relation to that day's duties are taxable here. Now, obviously, that creates tax burdens, huge complications in reporting, filing paperwork, etc. So there are a couple of quite important exceptions to this rule. So the first is where the individual is not resident. So residency in the UK is principally determined by the number of days that somebody spends in the UK in any given tax year. So our tax year runs to the 5th of April. And very broadly, if you're here for less than 45 days, you're not resident. If you're here for more than 183, you are. And between those extremes, it depends on your ties to the UK. But as a rule of thumb, if you're here for 90 or 120 days, you're probably not resident if you don't have sufficient ties to the UK. But as I said, it's governed by a statutory law. So it's one of the things we can look at with employees and say, look, provided you keep within these parameters, you're a non-resident. And the importance of being a non-resident means that if you're in the UK and you're here doing incidental duties, then those duties are not taxed. So UK authorities will say, we'll not tax you. And an example of an incidental duty might be you're here on a conference or you're sort of meeting customers. So that generally wouldn't be taxable under UK law. Another really important exception from the standard UK rule is afforded by the double tax treaty. Now, as Toby mentioned earlier, we have a significant network of double tax treaties, and the UK-Australia one is a very comprehensive example of one. Now, within that, there's what they call an employment article, And I put the summary on the slide there, but in essence, what it says is where you have an Australian employer, if you send an employee to the UK for less than 183 days, then provided the cost stays with the Australian entity, then that individual isn't subject to UK taxes on the duties they're performing here. Now, obviously, that's great for the individual, but it's also very good for the company because it means you don't have to consider taxes, social security, and payroll filing requirements. So you quite often see this in the early stages of a business sort of putting their foot in the water in the UK. If I could have the next slide, please, Toby. So local hires is, again, another sort of early stage, which we see where you've got an Australian entity that maybe wants somebody on the ground. Maybe they're not quite at the stage where they can get the visas arranged. So they employ somebody locally. Now, with a local employee, they will be subject to tax, regardless of where they do their work. They're subject to taxes in the UK. And that generally requires a payroll to be operated. So as an employer, you'd have to withhold taxes on a monthly basis and social security and pay that over to HMRC. There is a quite an interesting quirk in the system where employers who do not have a place of business in the UK can't be forced to run a payroll. So if you're an Australian entity with only a single employee in the UK and that employee does not create a place of business, then you don't have an obligation to operate a payroll, and simply they must operate their own payroll. So they must report information to HMRC themselves. Now, the significant benefit to this, as well as saving you a lot of administration, is you don't have an employer's national insurance liability. Now, as Toby mentioned earlier, that's potentially 15% of the salary being paid to the local hire employee. So you will save that liability by not having a place of business here. There's one catch: you cannot have a place of business within the EEA, because if you do, they can collect that money from the EEA and it sort of reinstates that liability. So again, something that comes up quite a lot, saves a significant amount of money in these sort of early startup period. So worth considering. If I could have the next slide, please, Toby. So permanent long-term transfers, I've got this slide in. It's similar sort of concept to the previous one, except you've probably got enough establishment here in the UK now to have to operate that payroll. There are certain incentives for a foreign national coming to the UK, and the rules have changed quite significantly over the last few months. And many of this is actually subject to a presentation I did to the Chamber of Commerce back in November, which I think is available to watch online. But in essence, if you're an foreign national or you've been living outside the UK for at least 10 years, when you come to the UK for the first 4 years that you are here, you can apportion your earnings between UK and non-UK duties. And the non-UK duties are, in essence, where you're physically located overseas. So if you've got somebody your base is the UK, but perhaps they're traveling around Europe, then any day they're physically working in France is a non-UK duty, and we can exclude that from UK income tax. So for those employees coming here wanting to travel, again, this is a real incentive to reduce their UK tax burden. Generally speaking, they've got to file a tax return to get this relief, but we can sometimes get it in the payroll as well. So again, just something to sort of entice people into the UK, I think. If I could have the next slide, please, Toby. So secondments is perhaps the most interesting area of sending employees to the UK, and certainly the carrot that you need to get people over here potentially. So a secondment is where you have somebody working for the overseas entity, and you are saying, we want to transfer you to the UK for a temporary period. Now, a temporary period is considered up to 24 months. So if you send somebody for this amount of time, you can claim they can claim as a tax deduction their general cost of living expenses whilst they're on the assignment. So that includes rent, utilities, home to work travel, food costs. And as you can imagine, those are quite significant expenses, and potentially they're saving up to 45p for every pound spent on those expenses. So it's really good. the employee saves the money. The other advantage to the employer is on a secondment where you send somebody to the UK for a temporary period. For the first 52 weeks, there is no employer's national insurance. So again, saving that 15% for the employer. Toby, can I have the next slide, please? So tax equalisation and protection, this is essentially, we use this as a tool to take tax out of the equation for the employee. So if you've got somebody, or if you're somebody yourself who wants to come to the UK, but you don't want to worry about the tax burden, you can do something called equalisation or protection. And in essence, what this says is, we're going to treat you as if you've never left your home state. We're going to treat you as if you've never left Australia. We're going to withhold from your salary what they call a hypothetical tax, and we're going to guarantee you a net payment. And in the UK, we'll gross up your tax and we'll pay it. Now, this can be quite expensive for the employer, so it needs to be looked at quite carefully. But if you've got an employee who qualifies for the secondment reliefs and maybe is travelling, we can really get the UK tax cost down, and those savings will go back to the employer in a tax equalisation scenario. So again, really quite a useful tool when looking at sending employees overseas. You've got to be really careful how you document this, of course, because as you might imagine, when there's refunds, employees sometimes think they belong to them, but really they belong to the company. So, it's all clearly documented, but it's a very useful tool, particularly with larger expat populations. If I could have the next slide, please, Toby. So, as I highlighted earlier, a lot of changes in the UK tax regime and how we treat foreign nationals. One of the exciting things is, and I think this is going to be relevant for a lot of Australians coming here, where you've been non-resident for 10 years. For the first 4 years you're here, your family members are not going to be subject to tax on your foreign income and gains. So what this means is, where we used to have to do quite a lot of pre-arrival planning before people come to the UK, now you get that opportunity to do a lot of that planning in the first 4 years. So if you had foreign assets and shares, they can sell them. And that makes it quite easy to get people over here quickly if you need to, because they don't need to do too much before they arrive. There are some changes which might put people off, although we're still waiting for clarifications on the rules. But inheritance tax is something that I know is a big issue for Australians in the UK. The rules are at the moment, if you're here for more than 10 years, you're potentially within the scope to UK inheritance tax. Usually we're looking at employee populations of less than 10 years. Of course, if we've got anyone who wants to stay longer, there are certain planning opportunities which we can do to mitigate that exposure. But generally speaking, I think the changes are good for employees coming to the UK, and there's plenty of opportunities. The things we do need to watch out for are, as I mentioned in the slide, trusts, which are quite commonly used in Australia, may not be tax efficient in the UK, and in fact can have adverse tax consequences. So they certainly need to be looked at prior to arrival, where you've got employees with trusts. Moving back to the employment, in terms of long-term incentive awards and shares, again, just needs a little bit of care to make sure we understand what those awards are, how they vest, because you can end up with a situation where you've got something granted before somebody arrived in the UK, and maybe it vests after they've left. But because you've got a period of UK employment in between, there could be UK taxes on that. So again, it's just ideally looking at these schemes before somebody comes to the UK, doing that analysis and going into it with your eyes open. There are lots of other sort of interesting points that you can get tax relief on. As an example, if you do second somebody from Australia to the UK and then you turn them into a local hire, this may trigger payments due to them in Australia, capital payments due to the termination of their Australian employment. Generally speaking, we can get those as exempt in the UK, either because it falls in that first 4 years or because we can get it exempt under UK rules. So again, potentially some planning opportunities to look at there. Okay, so that's a sort of very brief overview. I'll pass you over to Gerry now. Thank you.
Thank you, Adam. obviously, I work with both closely with both Toby and Adam, advising inward businesses coming into the UK to trade, and also those businesses from Australia who are moving into the EU. My specialism is VAT and duty, having specialised in this since the 5th of February 1990. So year 35 is just around the corner. Currently advise businesses from Australia who are in financial services, businesses that are selling goods that are not origin Australia, and also Australian businesses in the wine and spirits sector. So Toby, could I have the first slide, please? Okay, we're going to talk today about a number of things around VAT and duty, looking at goods and services, VAT registration. First point is always VAT registration. When do you need to register and why? Always split that down into two particular areas. Those that are established, and as Toby's talked earlier about branches or subsidiaries, basically a branch or a subsidiary will have a £90,000 turnover limit to VAT register in the UK, and there is two tests in meeting that 90,000. The first test is a rolling 12-month test, which looks at your turnover for the last 12 months. So if you were to exceed the £90,000 turnover test today, the 30th of January, you must register within 30 days. So you must notify your requirement to be registered by the 28th of February, and your registration date will become the 1st of March. Now, the second test is a realisation test. If you realise your turnover is going to exceed £90,000 in the next 30 days, the registration date is the date you become aware. So on 1st of January 25, you arrange a £95,000 contract. You must submit your registration application by the 31st of January, and a registration date will become the 1st of January. Now, VAT is one of these taxes which attracts a lot of penalties. You are in the UK, you are an unpaid tax collector, and you get penalised severely if you get it wrong. So in registrations, HMRC have a failure to notify penalty. If you fail to notify by the correct date, they will assess you for a penalty based on the potential lost revenue. And that penalty is usually set around 30%, but is usually levied at 15%. So be careful on VAT registration dates. You're also entitled to register on a voluntary basis if you're below the threshold, the £90,000 threshold, or you can also register as an intending trader. You're basically developing a business concept, you're incurring cost on the ground. HMRC will try to resist that, but we always go back and quote at them established case law, Merseyside Cablevision being a UK case and Rumpelmann being a European court case. If that business fails, then we're into basically it's abortive. And again, we point at law and say you can retain VAT recovery because of the European court in Ghent Coal BV. Now, you might say the UK has left the European Union. Correct, but basically a lot of the Withdrawal Act, basically all these concepts in previous cases have effectively come into UK law. HMRC are still quoting those cases at us. We're entitled to quote them back. Now, if you're not established in the EU or the UK, you have a registration threshold of 0. So if you do anything, you're liable to be registered. So it comes down to a case of basically, what's your business look like? Do you have boots on the ground, etc., in the UK that require you to be established? You have the human and technical resources to consume supplies. We'll say that you have certainly a fixed establishment for VAT purposes and therefore are established, and the 90,000 applies. So watch that aspect carefully. Determine what your position are, what your status is. And a lot of people get accidentally caught by the non-established point. I'll come back to that a little bit later. Toby, can I have the next one, please? Now, we're going to start with goods over the next couple of slides, then move on to services. We're looking at physical items arriving in the UK. Incoterms is the big driver here. In total, there are 11 Incoterms with 12 obligations within them. These range from X works through to delivered duty paid. Now, generally what I say around Incoterms is effectively depends who needs who most. So if you're really desperate to sell to that UK customer, you'll probably end up under DDP, where you are responsible for everything from the packaging to delivery to import VAT to customs clearance to duty, etc. The other 10 that are non-DDP, from Ex Works through to delivered at place, various bits are done by the seller, various bits by the buyer, but the important bit in all of those ones, it is the buyer who is the importer of record and has the legal obligation to import the goods into the UK and pay the duty and VAT. So could I have the next slide, please, Toby? Now we slightly move on a little bit and sort of make things slightly more complicated. Origin of goods will drive duty. Now, as David said earlier, that the free trade agreement between the UK and Australia will eliminate tariff on the majority of items across a number of years. But where you're buying goods, an Australian business is buying goods that is country of origin China or another, say, Southeast Asia country, you still have the issue of duty on arrival of the UK if the tariff dictates that it has a positive rate of duty. Now, there is, after the UK's decision to leave the European Union, there is a potential double duty trap. And what we look for clients is basically looking at supply chains, looking at markets, and trying to negate that double duty trap. Because if you have goods with a positive rate of duty that are landed in the United Kingdom, and then a proportion of those goods are then sent to the European Union, technically, you will have duty payable in the UK on 100% of the goods arriving, and you may then pay double duty on 40, for example, 40% of the goods that head into the European Union. Now, what we do there is we look at basically authorizations under customs procedures. Particularly in this case, we'd be looking at something like inward processing, and particularly Economic Code 21, which basically what Economic Code 21 allows you to do is effectively to unpack, repack and send back out again, and only those items that remain in the UK are subject to UK duty, and the items that go to the European Union are subject to duty in the EU. Now, there is a second problem out there for a lot of businesses. I've just finished work with one Israeli business and one Australian business who fell into a particular duty trap. They were basically having goods manufactured in China, and then those goods were being sent to the UK. Now, what HMRC are currently undertaking a significant campaign in this area. This resulted from the UK being fined by the European Union £2 billion, post the UK leaving the EU, but relating to issues whilst we were still a member around the policing of imports from China. HMRC are now looking closely at all imports from China, both on a classification and evaluation matter. And what the theme running through all this is that the Chinese supplier is offering to arrange the import into the UK on behalf of, say, the Israeli or the Australian customer. They appoint their own customs agent. Those customs agent basically accepts the numbers provided by the Chinese supplier, manufacturer. So that would be the classification or tariff code and the basic the values of the goods, etc. Now, what is happening on the ground is HMRC, who are certainly more active these days in customs duty than they are on VAT, are undertaking post-clearance inspections. Now, sometimes those are just administrative. It's your turn to be reviewed, or other times it relates to a shipment that has been stopped. HMRC have opened it, inspected it, and basically said, well, we want a deposit because we don't believe the duty and VAT is correct. And they follow up on that deposit where there has been no attempt to recover the deposit paid usually by the customs agent. So it ends up with being an awful lot of work for you, the importer, to basically amend all the entries, work with HMRC, be potentially penalised by HMRC for failing to declare the correct value at import. And fees for professional advisors at times outweigh the actual real cost to you. So what I'd say to anybody importing goods to the UK, please appoint your own UK import agent to ensure that the correct classification and valuation is applied to goods, because the admin hassle down the line well outweighs any perceived benefit. And while we're talking about goods, I mean, most of what I've been talking over the last couple of slides have been about business to business transactions. Business to consumer changes since we left the European Union. We're looking now at where you sell B2C, if you're selling goods to a private individual in the UK, and that consignment value is below £135, you can basically register, import the goods, no customs check, they just simply fly through the system, delivered to the customer, no hassle, etc. Above 135, generally you have to become the importer of record and basically pay VAT and duty, and then basically charge VAT to the customer. What you don't want as a supplier is basically goods coming into the country and the customer getting DHL coming along saying, we need £40 from you to release these goods to you because VAT and duty has not been paid. So watch the supply of goods into the UK, both from a B2B and a B2C aspect, because it can lead to issues, which obviously takes time and cost to business, which eats into profits. Could have the next one, please, Toby? Sorry, Toby, if you just stop and flick back one moment. Sorry, I missed something at the end. Just one point on the end of postponed import VAT accounting. When you bring goods into the UK, you can use PIVA. What PIVA means is you do not pay VAT at the point of import, and you basically make a plus and minus entry on your VAT return, and basically it saves you cash flow. So rather than basically pay the VAT and say 30th of January, your VAT returns are January, February, March, you won't get the benefit of that to 7th of May. Not paying it and using PIVA means you get instant cash flow advantage. Kind of the next one then, Toby, please. Services is generally, we'll do B2B very, very quickly. Basically, most of those services reverse charge. Very little VAT obligations in the UK around services. There might be some around live performances, land-related services, hire of means of transport, which can trigger VAT registration. The point I'd always make about services is check before you do it to make sure it's right. If you're established in the UK and you're buying in services from overseas, that will count to the UK VAT registration threshold. One other point is you can have sales staff in the UK, representative office, recovering all the costs of finding customers, then basically charging those off to the Australian parent at, say, cost plus 5%, full VAT recovery. And then finally, slide 5, Toby. The real complex area is services and B2C. Can trigger VAT registrations because there's basically issues around electronically supplied services. Those are items that are delivered over the internet or via an electronic network with minimal or no human intervention. What I'd say is where the situation is something like a customer clicks the buy now button on a website or downloads something, you're probably caught. Means a registration in the UK, probably means a registration in the European Union as well, and in many other jurisdictions. I've had one client who's recently had a request from Kazakhstan for them to VAT register for electronically supplied services. So it's things like online magazines, supplies of software, downloading of films or music, etc. If you're in that area, be very careful. And just one final point on VAT. Toby said earlier that you're talking about corporation tax 25% of profit. VAT isn't 25% of profit. In the UK, it's 20% of turnover, which can lead to a very big number and significant penalties. You know, you're an unpaid tax collector, you get it wrong, you get penalized. So getting it right and getting it right early would be my best advice to anyone looking to trade into the UK. And at that point, back to Richard.
Thanks very much, Jenstrom. Actually, Fisher, that was incredibly thorough. Again, I think in each of your presentations, there was that strong recommendation is do your homework early, plan early, don't dive in. It's the right advice. Thank you again for the three speakers. On to our final speaker. Just a thank you for everyone who's stayed with us. It is a long webinar, but thank you for staying with us. We'll probably finish a fraction earlier, I dare say, but again, thank you. The final speaker is something that we absolutely wanted to put on the agenda because, we say it, we heard it earlier from a number of other people, is that the UK is not London and London is not the UK. And it's important to understand that you do have options and there are other different geographic locations that should be on the consideration map. And not surprisingly, a lot of those other geographic locations outside of London have specialisations that they like to attract certain types of industry sectors into. And there's a lot of incentives as well that are offered by those geographic locations. And it's really important for people to be aware of those incentives and opportunities. And so on that basis, I want to introduce you to Chris Lau, who's the International Markets Lead for the West Midlands Growth Company. And I'll let Chris sort of talk to you about who they are and what they do. But they are a great example of a geographic location that is set up to really incentivise and promote their particular region. So on that particular note, over to you, Chris.
Thank you, Richard, and thank you to you and the team for inviting us to present, and thank you to everyone for staying because I know it's a late evening over in Australia. So West Midlands Growth Company, we are the strategic economic development vehicle for the West Midlands. We support the region in creating jobs. So by doing that, we attract inward investment, FDI, capital investment. We also promote the region for tourism. We also hold a lot of business intelligence, and our shareholders is the combined authority, which is headed up by the mayor, also our 7 metropolitan councils, and also the region's 5 major universities. So in a way to think of it, we're a bit like one of the state offices who operate sort of under the umbrella of Austrade, and in the UK sense, that is the Department of Business and Trade that we work very closely with. What we aim to do is that we want to bring public sector, private sector, and the higher education sector, so being that interconnector to create opportunities for companies and hopefully following that jobs. So what we do in terms of supporting investors like yourself is that all our services are free of charge. We help companies to conduct sort of in-depth research, tailored insights. We also help benchmark ourselves against other locations that you're considering, both from a cost sort of economic perspective, but also sort of business opportunities wise. We would also help facilitate access into some of our world-leading universities. The UK is extremely generous in terms of research and development grants, but also tax benefits. And often as a company expands, you would probably be considering to tap into our excellent graduate talent, so we can help you with that. If you're looking for premises, we can help you provide for a number of options. We would also help you build that business case if you are to persuade your board or your VC investors that you want to take that leap of faith expanding into the UK. And we have really good connections across with PR and on the comm side if you're looking to make a splash as you expand. Final bit, if you do decide to come to the UK, do drop us a line. If you've got some time to come up to Birmingham, to the West Midlands, we would love to organise familiarisation visits and sort of show you around the region on and introduce you to partners that are relevant for your sector. So a bit about the region. I don't know if you've been to Birmingham before. As a region, we've got 3 cities. So all three have very, very unique economic strengths and a lot of history and heritage. So there's Coventry, which is kind of the automotive capital of the UK. Wolverhampton, which has really emerged as a cybersecurity and so clean tech modular house construction hub in the UK. And then finally, Birmingham, which is the UK's 2nd city. We're very centrally located in the UK. At the moment, we're by train, we're an hour and 20 minutes away to central London with the High Speed 2, which is currently being built. That will bring that journey down to 52 minutes. And if you decide to drive, you can reach 90% of the UK within the 4-hour drive. We also have our own airport, Birmingham Airport, which is the UK's third largest regional airport, but which connects you to 133 direct locations. But we also have great connectivity just down the road with Heathrow Airport and further up into Manchester Airport. So we're really accessible by all means of transport. In terms of the region, once to give you a feel for what the region's about, we're 108 billion fast-growing economy. If we were a country of our own, depending on the exchange rate, we would probably be equivalent to Slovakia or Hungary. Population-wise, we've got the population of New Zealand. But what is really unique is that our population is extremely young. So about a third of our population is under 25 years old. About nearly 40% of that, actually close to half, 50% of them is under 30 years old. So that extremely young population is very rare in the UK, which means a very talented talent pool that you can tap into, but also a very unique consumer base if you're looking at B2C activities. We're also quite unique is that in the UK sense, we are still a major manufacturing hub. So about a third of the UK automotive export come from our region, and more uniquely, about 75% of that research in R&D manufacturing, particularly in automotive space, happens in our patch. We're what we call a full service economy. So we've got 175,000 businesses in the region. We're almost like a country of our own. If any services that you need from an accounting sense, professional services, manufacturing, banks, we've got all of that. We also have one of the highest startup rate outside of London for the last 5 years, and we also have 100 plus R&D assets. Some of it are leading commercial test beds, including likes of 5G, 6G technology, and some of them are really focused European, if not world leading accelerators focusing on clean tech automotive. So we've attracted a number of significant investment over the last 5 to 10 years. Some of the notable ones from US, for example, Goldman Sachs, who looked all around the Europe to set up their tech hub. They found London too prohibitively expensive to operate, and looking all around Europe, they decided to choose Birmingham as their first tech hub outside of major capital cities. So they started with 100 staff, grew into 500, and they're now saying they recruit up to 1,000 staff, which is a really interesting story, because if London is proving a bit too expensive for one of the major investment banks, that probably is a significant example of itself on some of the limitations deciding to expand in London. We also have a number of very significant investment all the way from India, from China, from Japan as well. But what you probably won't recognize, what you will recognize are probably the names in the first four lines, but what you won't recognize are the bottom 2 rows. And those are really fast-growing startups that we've attracted to come into the region and expand. I'll talk a bit more because some of that is down to a specific program which we're running, and it is available to all the Australian businesses who are on this call today. From the Australian side, we've had a number of significant investment over the last 2 years. These are all the names companies who have landed. One which we're really proud of is Harvey Norman, who decided to set up their first UK store in the region. That's a huge testament to that consumer base I've talked about, but also the confidence they have to us as a region. Agilex is one of the companies that joined that soft landing package I talked about, who are in the tech and consulting space. Lendlease, who are operating a major regeneration project in the city centre of Birmingham. We also have a number of other companies from Australia who are in the sort of the child toy production space, who've set up a production hub here. We've also got Contigo, who does waste to energy. Really wide spectrum of companies who have decided to set up here. What I wanted to do is give you a very quick flavour of sort of our key sectors. So I talked about our future mobility and advanced manufacturing. So we're the major hub for not just automotive, but also aerospace, rail industry. And one of the big opportunities in the creative digital tech is actually applying that technology into industry. So if your company is operating in that space, certainly worthwhile exploring or considering us as an option. We are also the largest gaming hub outside of London. So about 25% of the UK gaming export comes from our part of the region in a small place called Leamington Spa. So really interesting mix. Modern business services, which includes banks, professional services. So we've got the largest cluster outside of London. So apart from Goldman Sachs, another sort of big win for us was when HSBC decided to relocate their UK headquarters outside of London, and they decided to pick Birmingham. On the life sciences side, we're very focused on data and also medical devices. Our population base is quite unique, where it's very diverse, very young. It's all held under one database. So if you're a company who wants to do clinical trials or decide to do analysis on data or genomics, we're a perfect location for that. So huge opportunities in medical data, medical devices, but also in the clinical trial space. And finally, on the low carbon space, one of the major investment that we're courting at the moment is to build a gigafactory in the region, which will supply the likes of Jaguar Land Rover, Aston Martin, but also a number of other automotive companies in the region. We also have significant capability in the land remediation and energy storage, energy distribution space. And we also have Europe's largest modular house construction campus in Wolverhampton. So if you're interested in that construction space, certainly we're a region you shouldn't miss. So one thing I just wanted to talk about is our Global Growth Program, which is a soft landing package we launched during the Commonwealth Games when we hosted it in 2022. I'm really keen to capitalize on the back of the games to attract more investment companies to use the most out of this region to expand into the UK. What it involves is that we pay for 9 months of rent out of a 12-month contract. We connect you into key interlocutors. We get you plugged into ecosystem, but we also help you in terms of the basic setup. So the offices that we provide are fully serviced office in where our key economic clusters are based, fully serviced. Someone will take your mail. You can use it as your registered address. Basically, bring a laptop, plug in, and you can start working. We also help in terms of advising UK company setup. We've got key partners who can help on things like getting a UK bank account, which is quite often a bit challenging. They've got special banking licenses who, if they're comfortable with your books and act as for your bookkeeping, accounting services, they can act as a guarantor. We also help if you're deciding to come over with family to look at accommodation space, advising on schools, etc. So in this year, we've really expanded or revamped the program. Originally, the program only had one base in central Birmingham called Innovation Birmingham, where our tech hub is. We've got 200 tech businesses there and fast growing. Right next to the High Speed 2 station. What we've done is we've expanded into 6 hubs. So there's also the likes of Warwick Science Park, which is where our automotive companies are based. Birmingham Health Innovation Campus, which has just opened with leading clean tech, clean lab space. also right next to Europe's largest hospital in Birmingham, and also the university's medical school on the side. So bringing kind of that industry research collaboration, business opportunities all together in one space. So as a company, if you decide to come onto this program, you can pick one of the 6 bases as your main hub. You can also operate in the other 5. So in essence, you kind of get 6 sort of office space in the region you can operate from. We're mainly targeting companies that are in the tech space. So if you're in the clean tech, health tech, med tech, future mobility and digital tech space, we'll be very keen to speak to you about this program. So this probably lays out the support in a bit more detail. We kind of see it as 3 layers. So kind of the first level, so bespoke international support, the support that international companies require as they come and expand. Secondly, a sector thematic packages. So under each of the 4 sectors, we have 5 subsector programs. And depending on your needs, you can pick a mix and match of multiple or only one of that specific program to kind of get you plugged into the ecosystem. And we also organize regular industry roundtables with some of the biggest players. So for argument's sake, if you're in the automotive space, we organize regular roundtables with the major OEMs to talk about the latest issues, latest opportunities, or some of the industry trends. If you're in the medtech space, we also support in terms of how to get you accredited or accelerate that accreditation so that you can sell into the NHS or trial some of your technology. So I talked about those sort of business hubs. If you do join the program, we pay for 9 months of rent for up to 3 members of staff in that open co-working space. If you do decide to come in and then you're highly successful and decide to expand, you're able to retain that discount, and we'll be able to negotiate a good rate for a dedicated office space in all of these locations. So this program's live and open at the moment. If you can scan the QR code, you can access the brochures. They're dedicated brochures for each of the sectors I talked about. The only constraint at the moment is that this program's only funded until the 31st of March. So if you are interested in this program, you have to sign up before the 31st of March. I probably wouldn't recommend signing up on that day. Do give us a little bit of time, maybe a week or ideally 2-3 weeks before. We can look at your application. There's a 2-step process, and expression of interest with your contact details and an application. After receiving your application, we'll do a diagnostic meeting with our sort of sector specialists to really understand your business needs, whether we're the best fit for you and how we can support you. Last slide, you've got my contact details. If you're interested to learn more about the region, or next time you're in the UK, you do want to come and have a look and see it for yourself, we would love to welcome you. So I'll probably stop there. Back to you, Richard.
Yeah, thanks, Chris. Terrific summary and a great example of the opportunities outside of London. So thank you very much for that. And for those that have hung in there on the call, thank you very much. So we will send a note out to all of you in the next 24 hours, which will have contact details again for all our speakers, and also a link to the webinar itself. So that will be captured in a thank you email to all of you. We've got 3 questions. One's already been answered, but you can actually see those questions in the Q&A area itself. First question was around grants and soft loans available for incoming investors. Stephen from DBT has sent some links, which is terrific. So that's responded, and that also will be available to all people to link to and see. Another couple of questions we will get our team from HW Fisher to respond to. Let me ask this one, and I guess Gerry, this is probably one for you. If we buy an asset, a server in Australia, and ship to UK to set up in a data centre for our own business, would this attract duty and/or VAT?
Definitely attract VAT, no doubt about that. It'll be generally a case of basically what commodity code is the server imported under. I can have, whilst you ask the other question, I'll have a quick look at the tariff and I will try to answer the question before we go. But definitely VAT, no doubt about that. But it can be, you end up not paying it if you use postponed import VAT accounting. So effectively, you do a book entry rather than pay any physical cash out. But on the tariff code, I'm just checking if you want to ask the other question, which hopefully isn't for me.
Okay, will do. But well, actually it is. So, well, you're a popular man, Gerry.
Yeah.
And look, for those people that have asked the question, we can absolutely circle back and Gerry can contact you directly with your permission to provide the email contact. As an Australian proprietary limited entity, what are our VAT obligations if we begin a B2B trading in goods before we have a UK LLC entity?
Okay, so you're importing goods into the UK and supplying them before your date of registration. I assume that's the question.
Yeah.
Well, the main thing here, you can bring the goods in. You'll have to pay UK import VAT at the point of arrival.
Yeah, B2B trading.
B2B,
yep.
yeah, but you don't have a VAT registration number. You have no ability to use PIVA. You'll have to obtain an EORI number. That's automatic before you can bring the goods in. You will have to pay import VAT. There's no relief there at all with postponed import VAT accounting. You cannot operate the system because you're not VAT registered. So you have to pay the import VAT. Then when it comes to invoicing the customer, you can't show VAT on your invoice because you don't have a valid VAT number. You can only show VAT once you have a valid VAT number. So effectively, you'll be carrying a cash flow disadvantage until you regularize your registration position. So it's one of those ones. Do not show VAT on an invoice until you're registered, because technically it becomes a debt to the Crown and you can end up with double VAT.
All right. Another quick follow-up on that question, and I guess this is a general question in a way. How complicated is the process for an Australian entity to register with HMRC as a VAT participant?
Straightforward. Basically, there's a standard set of questions to answer. The issue is more how quick you need the number. VAT numbers are now at the moment taking anything from 8 to 10 weeks. That's the
great.
issue.
Thanks, Gerry.
Yeah, and on the import duty question, the duty rate will be 0, but VAT will apply on the computer server.
Thanks, Gerry. Your efficiency in responses means we're at 10:29 and we will finish perfectly by 10:30 Greenwich Mean Time, or 9:30 p.m. East Coast Australia. On that note, I'm going to thank all our speakers for their contribution. We covered a lot of territory. And to all the participants, thank you very much for joining us. And again, there is a lot of resources out there for you to lean into. And I think it's a great advantage, as we heard. And a copy of the webinar and contact details for the speakers will be sent to you shortly. So on that, good morning, good afternoon, and good evening to you.